Most people lose money in the stock market for one simple reason. They buy stocks without knowing what they're actually worth. And that's crazy when you think about it. Imagine walking into a car dealership, pointing at a random car, and saying, "I'll take it," without ever checking the price. Yet that's exactly how millions of people invest. They see a stock going up. They hear someone talk about it online. They buy. And then they wonder why they're constantly stressed every time the market drops. Today, I'm going to show you the exact system I use to avoid that mistake. You'll see my actual stock portfolio, every position, every price target, and the exact strategy I use to get paid while waiting for great companies to go on sale. Not theory, not motivation, real trades, real numbers, real process. But here's the thing, most finance channels never tell you. It doesn't matter how good a company is if you pay the wrong price for it. That one skill, knowing what a stock is actually worth, is the difference between investors who sleep peacefully during market crashes and investors who panic every time their portfolio turns red. I learned that lesson the hard way, and in the next 20 minutes, I'm going to show you exactly how I think about valuation, how I decide what to buy, what I'm buying right now, and why. And stick around until the end, because I'm going to show you a strategy called a cash-secured put. Most beginners have never heard of it, but it's the closest thing I've found to getting paid while you wait for an amazing company to become cheap enough to buy. Let's get started. Here's what I currently own. Now I want to be crystal clear before we go any further. That's not what this channel is about. Copying someone else's trades without understanding why they made them is one of the fastest ways to lose money in the stock market, even if you copy Warren Buffett himself. What I don't want you to copy is the process I used to buy each one of them, because that process, figuring out what a business is actually worth versus what the market is currently charging for it, that is the only real edge any individual investor has. Warren Buffett calls it price versus value. I call it the only thing that matters. Now let's go look at some stocks on my active watch list right now. Adobe, alert at $194.41. Tractor Supply, $29. Ulta, $462. Paycom, $123. Meta, $563. Microsoft, $371. Target, $131. Amazon, $233. Hershey's, $173 tea. Row Price, $109. Most of these are within 10 to 15% of where they're trading right now. They're getting close, and when they hit my price, I'm going to show you exactly what I do next. Let me show you exactly what price versus value looks like in practice. And let's use Microsoft, because right now, the market is absolutely terrified of this stock. Microsoft is down 20% this year, while the broader S&P is up around 12%. That is a massive gap. And the fear is coming from two very specific places. Fear number one, the spending. Microsoft has committed to spending $190 billion on AI infrastructure. That is a staggering number. And investors are asking a very logical question. When does that actually pay off? Because right now, you're not seeing it reflected in the stock price. Fear number two, the AI disruption threat. People are saying AI agents are going to kill the traditional software subscription business. Think about it. Microsoft makes a massive amount of money selling Microsoft 365, Teams, all of those seat-based licenses. Every employee at every company pays for one. But now the question is, if AI can just do these tasks automatically and cheaper, why would any company keep paying for 10,000 seats? That is a legitimate fear, and it's hitting the entire software industry right now. But here's what the numbers are actually saying. In Q3 of 2026, which ended in March, Microsoft's total cloud revenue hit $54.5 billion. That's 30% year-over-year growth. Their dedicated AI business, it crossed a $37 billion annual revenue run rate. Office 365 Consumer grew 7% year-over-year. On the business side, they have over 450 million users growing at 17%. Does that sound like a dying company to you? Now let's look at the financials. Market cap, $2.8 trillion. Enterprise value, $3.02 trillion. That $200 billion difference? It basically represents the net debt, and they generated $73 billion in free cash flow last year. They can easily handle it. Profit margins. This is what I love. 10-year average, 33.9%. 5-year, 36.7%. Last year, 39.3%. In the last decade, their profit margin has increased by nearly 20%. I look at that and I go, that does not sound like a dying business to me. Now here's where most investors stop. They read a couple of headlines, feel good or bad about the stock, and make a decision. That is not investing. That is speculating. What we're going to do right now is figure out what Microsoft is actually worth. Revenue growth. I'm putting in 7, 10, and 13% for the next 10 years. Profit margin, 34, 37, and 40%. It's been improving, but I'm being conservative. PE multiple I'd assign 10 years from now. 20, 23, and 26. High quality business. Big moat. Deserves a premium, but I'm not going crazy here. At 9% required return. Low case, $360. Middle, $545. High, $820. At my personal 15% required return. Low case, $234. Middle, $347. High, $514. Why do I use 15%? Because I have real estate, businesses, and ETFs. For me to pull capital into a single stock, the opportunity cost has to be really high. Your number might be 10 or 12%, and that's completely valid. This is why personal finance is more personal than finance. Based on this, I'm setting a buy alert on Microsoft at $350, not $330 like before. The analysis tells me it's worth paying a little more than I thought, and when it hits that number, I'm either buying it outright or doing something even smarter. I'll show you that in a few minutes. Let's do Amazon, because this is one of the most fascinating case studies in how to read a company that looks terrible on paper, but might actually be building something extraordinary. Amazon's market cap, $2.64 trillion. Enterprise value, $2.97 trillion. That's about $350 billion in net debt. Now here's where it gets interesting. Free cash flow last year? Negative $2.5 billion. But their net profit was $91 billion. So what happened? Capital expenditures. Look at this chart. $13 billion, $17 billion, 40, 61, 64, 52, 83. And last year, $150 billion in capital expenditures. Amazon is building the future in real time. AWS, advertising, logistics, AI infrastructure, all running simultaneously. This is exactly the reason I missed Amazon 12 years ago. I saw the messy numbers and walked away. Big mistake. 10-year profit margin, 6.5%. 5-year, 7.4%. Last year, 12%. It's moving in the right direction, fast. Analyst estimates, EPS of $9 growing to $175 over the next 7 years. Revenue of $840 billion growing to $1.66 trillion. Both roughly double. That's a lot of growth. Revenue growth, 4, 8, and 12%. I'm being cautious on the low end because of the CapEx drag. Profit margin, 8, 12, and 16%. My middle number assumes they hit their best margin ever and sustain it. I'm giving them credit for getting leaner. PE multiple, 20, 23, 26. And honestly, I think even my high number might be low for Amazon. The market consistently pays a premium for this business. At 9% required return, low $107, middle $240, high $485. The stock is trading right around $240. So at 9%, you're paying fair value. At my 15% required return, low $70, middle $155, high $304. The stock is at $240. That's too rich for me right now. Here's the key lesson from both of these analyses. The same PE number, 29, 38, whatever, can be either incredibly cheap or incredibly expensive. It all depends on what that company is going to do over the next 10 years. That's what you're trying to figure out. That's the whole game. And what you just watched me do took about 3 minutes per company. 3 minutes. That is more useful information than most investors gather before putting thousands of dollars into a stock. Because most investors look at the price, read a headline, and decide. That's not analysis. That's a guess. All right, now I want to show you the move that completely changed how I think about buying stocks. It's called a cash-secured put, and once you understand it, you're going to wonder why nobody taught you this earlier. What is a cash-secured put? Here's the concept in 3 sentences. You pick a stock you want to own at a price you want to pay. Someone on the other side of the market pays you cash today for the right to force you to buy it at that price. If the stock never drops to your price, you just keep the cash. If it does drop, you buy the stock you already wanted, and you still keep the cash. Either way, you win. Live example, Microsoft. Microsoft is currently at $375. My target price is $350. I go to the July 17th options chain and look at the $350 put. Someone is willing to pay me $3.41 per share right now for that obligation. Here's what that means in practice. Scenario A. Microsoft stays above $350 on July 17th. I pocket $341 per contract. I never buy a single share. Done. Scenario B. Microsoft falls below $350. I buy 100 shares at $350, but I keep my $341. My real cost basis is $346.59 per share. And here's what makes this even more powerful. The cash backing this trade is sitting in 90-day US Treasuries, earning around 3.7% annually. Stack these put trades on top of that, and I'm looking at roughly 12% annual return on my cash, while waiting for a stock I love at a price I love. If I wanted a 15% return and was okay paying $355 instead, the numbers get even better. Live example, Meta. Meta is trading around $573. My fair value based on my analysis is right around $570, so I'm not far off. I go to July 17th. I look at the $535 strike. Someone pays me $7.15 per share. That's a 16.8% annualized return on my cash. I'm going to be honest with you. I did not realize how good this was until I ran these numbers live for this video. I am going to sell cash-secured puts on both Microsoft and Meta this week. What's the catch? Here it is, the emotional catch. What if Microsoft drops to $300? I'm still paying $350 and I keep my $3.40. So some people feel like they lost $45. But think about it this way. I was planning to buy Microsoft at $350 anyway. If it falls to $300 after I buy it, I've experienced that same loss whether I sold the put or not. The only difference is I got paid $341 to do it. I don't experience this as a loss. I experience it as I got paid to buy a great business at a price I was already happy with. That's the whole idea. I'm either going to own a great stock at a price I love, or I'm going to pocket the premium and wait for the next opportunity. Either way, I feel like I won. I want to end with something that sounds simple but took me years to actually believe. A stock going up does not mean you were right. A stock going down does not mean you were wrong. What matters is whether you paid a fair price for a real business with a real future. If you did, a drop in price is just a better buying opportunity, not a disaster. The investors who panic when markets fall are the ones who never actually knew what they owned or why they bought it. The investors who get excited when markets fall, those are the people who did the work. They know their price. They were waiting for exactly this moment. I want you to be the second type of investor. Everything I showed you today, the analysis, the 3 scenarios, the cash-secured puts, it all comes back to one thing. Know what something is worth before you pay for it. That skill will pay you for the rest of your life. If you want to learn the cash-secured put strategy in full, I put together a free PDF that walks through everything. Link is in the description. And if you want to go deeper, I'm running a small group live class, 8 sessions, directly with me on Zoom. We go through stock analysis, grade your assumptions, build out your full process from scratch. Only a few spots left, and registration closes Wednesday morning. Link is in the description below. One thing before you go, drop a comment below with one stock you're watching right now and why. I read every single one. I'll see you in the next video.